Here's what's keeping Wall Street up at night. While the market just hit all-time highs, institutional investors quietly bought more downside protection in October than they have since April. At the same time, retail investors kept buying the dip like nothing's wrong. The fear index spiked 75% in just days, even though stocks barely moved. When the smart money is hedging this hard while Main Street keeps piling in, something's off. How are you supposed to invest when the professionals don't even trust their own rally? In this video, I'm breaking down 4 completely different scenarios based on where you are in life. After coaching over 1,000 clients through every market condition, these 4 situations cover about 90% of you watching. Scenario 1 is for anyone 5 to 7 years from retirement. Scenario 2 covers people already living off their portfolio. Number 3 is for those with 15 plus years until retirement. And Scenario 4 tackles what to do with a sudden windfall. Scenario 1, 5 to 7 years from retirement. You're close enough that a major loss would be devastating, but far enough out that playing it too safe could cost you hundreds of thousands in gains. Here's the reality. Volatility spikes like October's typically mark short-term bottoms, but we could still see serious choppiness ahead. The worst move you could make is panic selling everything into bonds because you're scared. More money has been lost by investors sitting on the sidelines waiting for crashes than has ever been lost in actual crashes. You sell near the bottom, miss the recovery, and never get back in. Keep 75 to 85% in equities with a specific game plan. Put your biggest chunk, maybe 50%, into broad market index funds, tracking the S&P 500. Analysts are projecting double-digit earnings growth for 2025, so you want that exposure. Then allocate 25 to 30% into quality dividend funds like SCHD or VYM. These give you stability plus income. SCHD currently yields close to 4% and has grown its dividends at nearly 10% annually over the past 3 years. That's defensive positioning with serious growth potential. Keep maybe 10% in growth funds like QQQ for upside, but don't go crazy. And here's the critical part, that remaining 15 to 20% sits in high-yield savings, earning 4% or better. This is your opportunity fund. When we get our next 10 to 15% pullback, and we will, that cash lets you buy aggressively while everyone else panics. Those dips in your final working years are golden opportunities if you're prepared. Scenario number 2, already retired living off your portfolio. This is fundamentally different. You're not earning a paycheck. Your portfolio is your paycheck. If the market drops 20% and you're forced to sell to pay bills, you're locking in permanent losses you can never recover. Priority number 1, have 3 full years of living expenses outside the stock market in high-yield savings or money markets. Let me get specific. Say you need $75,000 a year to live, and you get $30,000 from Social Security. You need $45,000 annually from your portfolio. 3 years of that gap means $135,000 in cash, not 3 years of $75,000. 3 years of the $45,000 gap you need to fill. Why 3 years? Major corrections can take 18 to 30 months to fully recover. With that cushion, you never sell stocks at a loss. Your investments recover and keep paying dividends while you live off reserves. For your actual portfolio, shift heavily toward income. Structure it like this: 50 to 60% in dividend-focused funds like SCHD, VYM, or Dividend Aristocrats, companies that have raised dividends for 25 plus consecutive years. Another 25 to 30% in S&P 500 or total market funds because you still need growth. You could be retired for 30 years, maybe 10% in short-term, treasuries for extra stability. The remaining 5 to 10% in a quality growth fund because technology will keep advancing. The beauty of 3 years cash, you can completely ignore volatility. Market drops 15%, doesn't matter. You're not selling anything. You're living off your buffer while stocks recover. That psychological freedom is priceless. Scenario number 3, you're 15 plus years from retirement. This is where people make the biggest mistakes going both directions. Some chase whatever's hot and go all in on speculation. Others get way too conservative way too early. Both approaches are wrong. First, eliminate all high-interest debt before investing $1. If you're carrying credit card balances at 22% interest, no investment makes sense until that's gone. Even if you got 15% returns in stocks, you're still losing money after paying that interest. Kill anything above 6 or 7% interest first. Once debt's handled, invest in both retirement accounts and taxable brokerage accounts. Retirement accounts give tax advantages now or later. Brokerage accounts give you flexibility before the age of 59 and a half. I do roughly 70% retirement accounts and 30% brokerage. Now, here's where people get seduced. Right now, it's AI stocks. In 2000, it was internet companies. That bubble destroyed people. In 2007, it was real estate. We know how that ended. There's always an easy money story. It's always wrong eventually. Build a balanced foundation, split roughly in thirds. First third, value and dividend funds like SCHD for stability and growing income. Second third, broad market exposure through S&P 500 or total market funds. Third third, growth funds capturing innovation. If you want higher risk plays like tech-focused or sector funds, keep those to 5 to 10% maximum. You're young enough to handle volatility because you're earning from your career, not your investments, but you're not young enough to be reckless. Balance wins when time is on your side. Scenario number 4, you just received a windfall. Maybe it's an inheritance, a big bonus, a business sale, or a settlement. You've got substantial cash and the pressure is real. Invest it all now? Wait for a crash? Something in between. Take this completely off the table, sitting on the sidelines waiting for the perfect moment. Research shows lump sum investing outperforms gradual investing in about 2/3 of scenarios because time in market beats timing the market. But I understand psychology. If you put $200,000 in today and the market drops 15% next month, you'll be mentally crushed. Here's my hybrid approach. Invest half immediately into a diversified portfolio. If it's $150,000, put $75,000 to work today. Split it across broad market funds, dividend funds, and growth funds based on your age and risk tolerance. The other half, dollar cost average over 4 to 6 months. That's $12,500 monthly if you do 6 months. This gives you 2 advantages. Half your money immediately starts working and earning returns. The other half averages in if we hit turbulence, which helps you sleep at night. Here's something most people miss. Corporate buyback programs go dark during earnings, but reopen in early November. November and December are historically the strongest buyback months, creating natural buying pressure. Even if we see October weakness, positioning ahead of that seasonal strength makes sense. We're in a strange market. Stocks hit new highs, but underneath there's more anxiety than you'd expect. That disconnect doesn't last forever. Either worry fades and we rally, or worry proves justified and we correct. But here's what I know after 1,000 clients through multiple cycles. People who build real wealth aren't trying to time every move perfectly. They have a strategy matched to their life stage. Stay invested through noise and buy when others panic. Whether you're 5 years from retirement, already retired, 20 years out, or sitting on cash, there's an approach that works for your situation. The worst thing is freezing up and doing nothing because you're paralyzed by uncertainty. This is educational content only and not financial advice. Consult a financial advisor before making investment decisions. Past performance doesn't guarantee future results. Please like, share, and subscribe. Here's to your investing success and profitable investing.